The Asian financial crisis of 1997 was a financial crisis that affected many Asian countries, including South Korea, Thailand, Malaysia, Indonesia, Singapore, and the Philippines. After posting some of the most impressive growth rates in the world at the time, the so-called tiger economics saw their stock markets and currencies lost about 70% of their value. As a result of the devaluation of Thailand's baht, a large portion of East Asian currencies fell by as much as 38%. International stock also declined as much as 60%. Luckily, the Asian financial crisis was stemmed somewhat due to financial intervention from the IMF, which is the International Monetary Fund, and the World Bank. As a result of the crisis, many nations adopted protectionist measures to ensure the stability of their currencies. This often led to heavy buying of US treasuries, which are used as global investments by most of the world's sovereigns. The Asian crisis led to some much-needed financial and government reforms in countries such as Thailand, South Korea, Japan, and Indonesia. It also serves as a valuable case study for economists who try to understand the interwoven markets of today, especially as it relates to currency trading and national accounts manager. It began with a series of asset bubbles. Growth in the region's export economies led to high levels of foreign direct investments, or FDI, which in turn led to soaring real estate values, bolder corporate spending, and even large public infrastructure projects, all largely funded by heavy borrowing from banks. Of course, ready investors and easy lending often lead to reduced investment quality, and excess capacity soon began to show in these economies. The United States Federal Reserve also began to raise its interest rates around this time to counteract inflation, which led to less attractive exports. However, the tipping point was the realization by Thailand's investors that its property market was unsustainable, which was confirmed by Somprasong Land's default and Finance One's bankruptcy in early 1997. After that, currency traders began attacking the Thai bahts pegged to the US dollar, which proved successful and the currency was eventually floated and devalued. Now, following this devaluation, other Asian countries including the Malaysian ringgit, Indonesian rupiah, and Singapore dollar all moved sharply lower. These devaluations led to high inflation and a host of problems that spread as wide as South Korea and even Japan.
Hi guys, in this video we're gonna explain to you on how Malaysia responds to the Asian financial crisis. First method on how Malaysia respond to the crisis is by using monetary policy response. In history, it says that at first, Bank Negara doesn't want to pursue with tight monetary policy. So, what does it mean by tight monetary policy? Tight monetary policies means that we increase the short terms of the interest rates. So by increase the short-term interest rates, it will increase the cost of borrowing, and this will lead to the decrease in the attractiveness of the borrowing cost. However, when the Bank Negara sees that the ringgit Malaysia remain volatile against the currency of the US dollar, Bank Negara implement this strategy by increase the interest rate from 7.6% in September 1967 to 8.3% at the end of the year. This increase in the interest is to stabilize the panic in the financial market. So Bank Negara implement this strategy until 1998. Other than that, they also do the restrictions against the loan on the purchase of assets, non-commercial vehicles, and also for the property. Beside monetary policy, government also made change on their fiscal policy to address on that crisis. So what does the government do? The first one is government give tax incentive to increase the value of exports and also import duty to the consumption's goods, as well as completely build up and completely knock down on the luxury car. Besides that, the government also increased the contributions of the EPF from 5% to 7%. In addition to that, the government also decreased the corporate tax rate from 38% to 30%.
In addition to the both previous points, Malaysia was also implementing capital controls in order to reduce the interest rate without consequences adverse the exchange rate. So where the Malaysian authorities implementing the selective capital controls on 1st September 1998. So on that time, the Ringgit Malaysian exchange rate was fixed at 3 ringgit 80 cents to the US dollar. So these implementations was actually to stabilize the currency and also the stock markets. So besides that, the central bank on that time was also benefits from this measurement by regain some monetary autonomy. So the results of the loose monetary policy was not only felt in this measure, but also including in the reduction of the statutory regulatory requirements SRR, and also in the reductions of 3 months interbank rates. So the new base lending rate was actually determined by a new interest rate selected using a 3-month monetary policy intervention rate. So this actually helps to reduce the restrictions of the property and stock buyings. So as a result, the interest rate was dropped significantly using this implementation of capital controls. So the 3-month interbank rates was reduced significantly to just above 3% in mid-1998 from a peak at 11% in mid-July 1997. Isn't it cool, right? The last point under this subtopic is the government was implementing a financial structuring program which involved and first, I will explain on Dana Harta. Okay, Dana Harta was actually formed to remove the non-performing loans in the bank's balance sheet. So the banking sectors which have gross non-performing loans above 10% would need to sell the non-performing loans to the Dana Harta. And as a result, Dana Harta will pay cash or issue government guaranteed bonds to pay for the non-performing loans. Dana Modal is a wholly owned subsidiary of Bank Negara Malaysia, which they have two tasks. First is capital injections into the failing banks, and also secondly, the consolidation plan of the banking sector.
If we are looking back, the Asian Development Bank reveals that 5 countries are most affected with the financial crisis, which are the Malaysian, Filipina, South Korea, Thailand and Indonesia. Asian Development Bank found that income per person had all recovered to at least their level before 1997. There are several paths to the economic recovery. First, financing must be through the viable borrowing rather than through the money creation, because The latter will be inflationary and will hit the poor. The domestic interest rates are high. External financing may be desirable to the extent possible. Third is, level of fiscal deficit should be tailor-made for specific countries with higher level, less indebted countries. There are many challenges for the future. Expansionary policies cannot be effective in the longer term without structural reforms. Despite the commendable efforts in the past year or so, the reform agenda is long and tedious. For example, the affected countries have only made a beginning in reforming the finance sectors. The process will take years. The East Asian countries are facing a systematic bank crisis. The social cost of the crisis have been immense. When designing and implementing expansionary policies and the structural reforms, the poor must be protected and must share in the fruits of recovery. This requires proper macroeconomic policies.